This is TreppWire Week in Review for the week ending January 5th, 2024. I'm Haley Keene with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Lonnie Hendry, Chief Product Officer, and Stephen Bushbaum, Research Director. This week, we saw signs of continued cooling in the labor market, but nothing that would seem to indicate that significant labor market weakness is a near-term concern. We also await Friday's jobs report, which could be a signal for those searching for positive signs in the market. Stephen, is the decline in stocks and increase in bond yields this week a sign of negative sentiment, or are we just normalizing after the holidays and a strong 2023?
Really, I think this was more of a sign of normalizing. If you think about where we came from throughout December, we took such a huge leg down in bond yields, and stocks rallied a ton after the Fed dovish pivot. So this feels like we're coming off of 2 weeks from the holidays where bond yields came down a little bit more. We continued to get the Santa Claus rally. And right now, we just took some chips back off the table after a strong rally. And now we are really thinking long and hard about, okay, was what the market pricing out for rate cuts in the future for the Fed fair, or should we really reconsider what kind of resilience we've seen and perhaps pull back some of the expected rate cuts that have been priced in? And specifically, the Fed signaled 75 basis points in rate cuts for 2024. And at one point, the market was pricing about twice that. So if we look at the CME Fed Watch tool, this, I think, tells the story perfectly of what we've seen play out this week. 1 week ago, the probability of a 25 basis point rate cut in March was just above 72%. And that's come back down to about 62% over the past week. And so if you're pricing that higher for longer for growth stocks, remember that the tech sector now accounts for a massive weight in the S&P 500. So if we look at the performance across the different indices, the S&P and NASDAQ are down the most, and the Dow is actually the best performer. They're still negative year to date. Call it right about negative 0.7% year to date return. S&P is down 1.7%. NASDAQ is down a little over 3%. So it's the tech sector, the growth sector, that continues to be the underperformer, which tends to be the case when you have an expectation of higher rates. Those future cash flows, the future growth, this gets discounted and values decline over the near term. So I think that's just really normalizing, to get back to answering that question.
Yeah, I would agree with you, Stephen. I think it's a normalization. I think all of us would agree that the run up after the Fed's dovish positioning was maybe a little bit overzealous, and people are starting to come back to a little bit of reality relative to where we're at in the market. And I mean, the dot plot is a leading indicator of what they think will happen, but it's not actionable, right? It's not like it's baked in that says this is going to effectively happen. And so it'll be interesting to see how the next couple of weeks play out. But we talked about on last week's episode, the 10-year and the roller coaster, the volatility that it had. But if you look at the year end to year end, it was relatively flat. I think this is kind of to be expected at this point. So we'll see, as some of these additional, macro drivers and reports and other things get pushed out in January, where is the sentiment for the market and the economy at large? And I think we'll start seeing a normalization. To that end, we have private payrolls that came out 164,000 in December, which beat expectations. This was according to ADP. The private payrolls were up more than the 101,000 in November and better than what was estimated, about 130,000, and really led by the leisure and hospitality space. So, pretty much throughout 2023, leisure and hospitality had led the way. So they did take a little bit of a downturn towards the end of the year, but in December, rallied and added 59,000 positions, which was really interesting to see them come back with a vengeance. They also led in wage gains with annual growth of 6.4%. If you look at the jobs openings numbers, they nudged down to the lowest level in more than 2 years. And that's according to the job openings and labor turnover survey. The JOLTS report showed that employment listings nudged lower to 8.79 million. Which is right in line with what the Dow Jones estimate was at 8.8 million. But again, the lowest level since 2021. And the ratio of job openings to available workers fell to 1.4 to 1, which I think is of interest, still elevated, but down sharply from the 2 to 1 that had been prevalent throughout 2022. And then lastly, if you look at initial jobless claims, They fell to their lowest level since mid-October in the last week of 2023. So there's still going to be some seasonal adjustment stuff that comes out on this. But if you look at those initial claims figures, they're pretty much in line with labor market conditions, and that there's loosening but not unraveling because there's just, relatively few layoffs. So I think to your comments earlier, Stephen, things still look healthy. I think people are still relatively bullish. I think there was just a, slight normalization over the last week or two, starting off 2024.
One thing that I've been chewing on here the last day or two is we dropped below 4% on the 10-year Treasury. So in terms of funding costs for real estate, is that 4% level, does that have some psychological importance for underwriting deals in today's market, do you think, Lonnie?
Yeah, I think it does. Like where we were at during the zero, interest rate phenomenon and QE and everything was such an aberration. But it seems like the market's kind of drawn a line there at that 4% threshold, that anything above 4 really starts to choke out some of the market activity. And I don't know if, I haven't done any analysis to see, is there really some magical phenomenon that happens over 4 where deals really don't pencil, but they do? I don't think so. But I think there's definitely a psychological stigma that anything with a 3 handle means the market's pretty open for business and deals can get done. When things start teetering above 4, and as we saw, in 2023, where 5 is not out of the question and maybe 6 or 7 is still in the realm of reality, the market seems to really start to choke itself out.
So Friday's jobs report will be a big signal for the market looking for good news. This is coming from CNBC. We've got some good commentary here. So when this December jobs report hits Friday morning, markets will be looking for a number that hits the sweet spot between not so robust as to trigger more interest rate hikes, but not so slow as to raise worries about the economy. So the classic threading the needle jobs report number. So in my mind, I'm thinking, gosh, if we get a breakout to the positive or the negative, do we start to see some really large action on the long end or even the short ends of the Treasury curve that'll have implications for markets? Because if we think ahead to the Fed meeting, Friday's jobs report will be the only one that the Fed will have to work off of for their upcoming meeting. And I don't think that really has a lot of importance because if you look at the futures probabilities, there's, by and large, everybody expects the Fed to stay on pause. The likelihood of a rate cut is extremely, extremely low. But I think more important is how that plays into their forward guidance. Because right now we've been playing off of the Goldilocks narrative that has allowed the Fed to get a little bit more dovish in their forward guidance than at least I was expecting back in November before their last Fed meeting. So I think this will be a very interesting jobs report if we do get some action either to the positive or negative side for surprise.
Yeah, I agree. And it's interesting, Steve, we haven't really talked about this side of the narrative, but maybe the Fed knows something we don't, which is why they had such a dovish pivot when none of us really expected that to take place when it took place, and I think the markets reacted the way they did because they didn't think that way. But if you objectively look back, they've been saying this higher for longer, higher for longer. Now they're tapping the brakes with the potential for rate cuts, fairly soon. Maybe there's something in the data or something that they're privy to that gives them reason for pause that maybe hasn't made mainstream media at this point or hasn't been part of the equation, at least around the talk track. It'll be interesting to see what the jobs report says. I definitely think it's a bellwether. But again, I don't think there's expectations at this point that there's going to be significant movement that would trigger, one reaction or the other. I think hopefully this comes in, we're still talking Goldilocks, and we can just move on with 2024.
Yeah, certainly for real estate markets, the deal thaw, the increase in transaction volume that we got in December was really a relief. Getting back to the psychological element of this, when you see transaction volume pick up like that, that sort of positivity does play into your forward scenario analysis, your pricing to at least some degree. So I'm with you, Lonnie. It would be really nice if we can continue to hold this Goldilocks narrative. Because that does play into the underwriting mentality and the scenarios that get run real time on the ground. One interesting piece that we got this week from the Wall Street Journal was that apartment rent relief is expected to continue. The apartment rental market finally stopped clobbering tenants with big price increases in 2023, and that trend is likely to continue in the new year, even as job growth and housing demand remain high in parts of the country. So relief for tenants has come at a time when the surge in new supplies pushed vacancy higher, making it harder for landlords to raise prices. And also, many tenants have simply reached their limits on what they're able to pay for. I know when I moved to New York, I've heard okay, how much rent can you afford on your paycheck? And sometimes it's stated as, well, it should account for no more than 30% of your income. When I moved to New York, the guideline was, well, your rent should be about 1/40th of your monthly income. Or to say this another way, your annual income should be at least 40 times what your monthly rent is.
Yeah. So I think, to your point, those numbers vary and for good reason. Like if you live down in Texas where I'm at, you have to have a car with insurance and gasoline and all of the stuff, the maintenance that comes with that. And if you live in New York, you may not have to have a vehicle for daily commutes and you can afford to attribute a little more of your income towards rental rates. But we talked about it on the podcast a few months ago, Stephen. Haley had given us a number. I want to say the median rent in Midtown was something like 5,000 a month or something for a studio apartment. It was like out of control. I think this is kind of a double-edged sword. It's good for the renter that rates have started to abate some and that there's some, slowdown in the rental rate growth. From our perspective of like dealing with the data every day on the finance side, it's not great because we know a lot of these deals were underwritten with rent growth expectations, not that rent growth would stay flat or negative. And that has, implications for refinance and implications for, just operating the property at a profit. And so, part of me is super happy for the folks that are maybe getting a little bit of a reprieve on the rent side that they're having to pay every month. But I'm cognizant of the fact that dial back of rent could potentially, have some negative consequences for the owner operators of those units that maybe bought the property in the last 18 or 24 months. And so, yes, if you look at that property over the last 3 years, there's been dramatic rent growth, but they didn't actually capitalize on that rent growth. The previous owner did, and then sold the asset at an inflated price relative to what today's market supports.
So last week, you guys gave your predictions for an array of topics, including CMBS delinquencies for the next year. And then this week, we actually came out with what the final number was for CMBS delinquencies for December 2023. So why don't you walk through the findings?
Sure. The CMBS delinquency rate fell modestly again in December 2023. Overall, the delinquency rate fell 7 basis points to 4.51%. In the heavily watched office segment, delinquencies fell for the first time in several months. The office delinquency rate dropped about 26 basis points to 5.82%. Now, if we included loans that are beyond their maturity date, but still current on payments, the delinquency rate would be 5.49%, down 9 basis points from November. The percentage of loans in the 30 days delinquent bucket is 0.23%, down 9 basis points for the month. Now, our number, just to clarify for the audience here, our number assumes that defeased loans are still part of the denominator unless otherwise specified. Those of you in the industry, to say this another way, these numbers are not defeasance adjusted. They still include defeased loans. Overall property type analysis, CMBS 1.0 and 2.0 loans. To clarify, the CMBS 1.0 loans are those loans that go back pre-GFC, and 2.0 is anything that got issued from 2010 forward. So the overall property type analysis, the industrial delinquency rate increased 19 basis points to 0.57%. Lodging delinquency rose 19 basis points to 5.4%. Multifamily delinquency moved up 16 basis points to 2.62%. Office delinquency fell 26 basis points to 5.82%. And retail delinquency dipped 10 basis points to 6.47%.
Yeah, there's some interesting takeaways from this month's report, Stephen. I mean, the overall headline number being down is a good thing. The office is obviously good, although I think that's an anomaly relative to where we're at in the cycle. Like, there's more office distress that has to be coming down the pipeline that just hasn't shown up in the data yet. If not, we've effectively spent the last 18 months talking about something that, relatively speaking, would be a non-event. I mean, if peak office delinquency is somewhere at 6%, 5.5 to 6, like all things considered, it's a fairly non-event given what we've been hearing and talking about and obsessing about for the last year plus. Multifamily is the one that's interesting. If you look at multifamily on a 12-month basis, it's seen a very dramatic increase. And if you look at multifamily from the perspective of just how many complexes there are, that continues to be something that I would keep an eye on. But at 2.62, there's nothing to start ringing alarm bells about at this point.
So piggybacking off of that multifamily rate, Lonnie, we used to do a lot of these segments where we kind of brought some education to the podcast in the form of 101 segments. And we have a special one today for the multifamily segment as a whole. So let's dive into our findings there and give our listeners some background on what we're seeing and the fundamentals of multifamily.
Multifamily has a special place for me. That's where I started out in the commercial real estate industry. I think multifamily, I'm a little bit biased, but to me, it's the best asset class to invest in for a bunch of reasons, which is not part of the CRE 101, but I think it's germane that we talk about this. I mean, multifamily has started to see some cracks relative to the performance over the last several years, still outperforming most every asset class. But we wanted to talk through a couple of headline topics and then maybe drill down into some of the nuance around it. So if we were to say, like, what are the current challenges that are being faced in the multifamily sector? Some of these our listeners will have heard about and read about ad nauseum. Some of them maybe not as much. The short-term floating rate debt with rate caps, obviously been talked about extensively. Slow or no rent growth, Stephen just talked about that a moment ago. We're starting to see that broaden out to a bunch of different assets. So not just Class A or Class B, it's basically a lot of the multifamily space. Large increases in operating expenses. Some of this is inflationary, some of this is insurance driven, some of this is just operators that aren't able to effectively manage those expenses like you would expect them to. Significant increase in new supply, inexperienced operators, and then obviously just higher leverage deals that have additional risk attached to them. So those are pretty straightforward on the challenge side. I think where we start to see some of the CRE 101, and I think where this is timely for our listeners, is some of these other topics. So, what is a going in cap rate on some of these deals? So you've heard us talk about on the podcast cap rates, and cap rates are interesting because depending on how you calculate the cap rate, whether you're including reserves, not including reserves, if you're using a stabilized NOI or using a non-stabilized NOI, those numbers can fluctuate greatly. So a lot of times when something's purchased, what gets reported is the going in cap rate. And the going in cap rate's basically looking at the trailing 12-month NOI divided into the current purchase price. In practice, those can sometimes give you a little bit of a perspective of the asset that maybe doesn't meet what the investor plans to do with it. So in this example, trailing 12-month NOI is significantly less than what the operator's projecting. Once the asset's being repositioned and stabilized, it's going to look like a really low cap rate. They're effectively buying that upside, though, when they buy that non-performing asset or asset that's not performing at market, and they're going to bring it to market. However, when you do that, you're increasing the risk in the sense that you have to execute a value add or reposition of the asset, right, to achieve that market stabilized NOI. So that's the first thing. We hear a lot about cap rates. We hear a lot about multifamily cap rates still being really low. The question that should follow those is this asset running at market in terms of market rent, market occupancy, and is that a reflective stabilized market cap rate, or is that something where the investor's buying it hoping there's upside? They have an execution plan in place to put into practice. What we've seen is a lot of those haven't gone to plan. And Stephen, talked about that on our last Market Pulse webinar. To just kind of further the cap rate discussion, cap rate effectively is just a multiplier. And so you divide the NOI by a cap rate. But just to give some perspective here, if you look at each dollar of NOI that a property generates and you divide it by a cap rate, it converts that dollar of NOI into some multiple in terms of property value. So $1 of NOI at a 3% cap rate equates to $33 in property value. So for every dollar you generate an NOI at 3% cap rate is $33 in property value. $1 of NOI at a 4% cap rate is $25. $1 to 5% cap rate is $20. $1 to 6% cap rate is $16.67 in value. I don't think people realize when we're talking about sales or others that this one sold at a 3.5 cap and this one sold at a 5. What a dramatic difference that actually is for the property value.
Yeah, and if we think about cap rates and the Fed rate hike cycle, let's put some simple math behind this. If you were buying a multifamily property at a 3% cap rate, paying $33.33 for every dollar of NOI you're going to receive, and then rates have risen, but let's just say you go from a 3% cap rate to a 6% cap rate. I mean, that's a really dramatic change, but just for numerical purposes, by taking the cap rate up that much, your property value declines 50% with just a basic change in cap rate. Now that's artificial because we know, well, you're buying the property today and it's going to be a 5 or 10 year hold, and you're going to get some cash flow growth. Typically from these multifamily properties, you're going to track somewhat to inflation. And certainly if it's a value add deal, you're going to be trying and bumping the rents even more. So there's a lot of other math that goes into it. But just when we think about what the rate hike cycle has meant for property values on a cap rate adjustment basis, it's incredibly dramatic. Even going from a 3% cap to a 4%, well, that's a 25% decline in property value. That's extremely painful.
Yeah, and I think that's the part that just gets glossed over sometimes in the headlines. But in reality, if you're the owner of that deal and the cap rate changes in the market, then you're saying a 25% write down. We've talked about for 2023, the bid ask spread in a lot of these instances are 20 or 30%, really could be attributed to a 100 basis point change in the cap rate. The other thing we want to talk about, not all income is good income. So sometimes when you're looking at underwriting a deal, they may have late rent and associated fees that show up on a line item. That's really not great income. Again, for every dollar of NOI that generates at a certain cap, it multiplies that in the value, but you probably don't want to underwrite that. Amenity fee income, garage rentals, when the market starts to tighten and renters start getting pushed on the rental rate side, they really cut down on those extras. So if there's amenity fee revenue or garage revenue or other type of non-rental income, a lot of the times those deteriorate fairly rapidly. I think something else that we've seen in practice over the last cycle is operators turning 10 or 20 units or maybe 30 units out of 250, showing that rent gain on that small sample set, but then selling it on an extrapolated basis where someone comes in and says, well, we're going to underwrite being able to achieve that type of rent growth across the universe of units. And in reality, those 10 or 20 units, maybe we're on the front end of the cycle. And for the remaining 150 or 200 units, you're only going to get half of what the rent growth was. Definitely a challenge there. And I think the other thing, and then I'll let you chime in, is expenses. We've done some extensive work on our research team looking at expenses on multifamily. Obviously, when you go in and you purchase the asset, two things most operators think is we're going to increase the rents and value of the rent side, and then we're going to minimize expenses. But in practice, a lot of times operators are locked into long-term deals with certain expense categories. So trash service providers, a lot of times they want a multi-year agreement in place. So you're not able to go in and immediately lower that cost. That's a cost that may be borne on you for a while. Landscape companies, if you outsource unit turnover, a lot of times those are done on a contract basis where irrespective of who the owner is, those fees are kind of baked in. Then you back into this inflationary environment we have now where it just costs more to hire people. Supplies cost more. Supply chain issues means turning your units takes longer. All of those things, compound to show significant increase in the expense side of the equation, which a lot of folks were not expecting when they acquired certain assets.
Sure. And I think, tying these two together, thinking about some of the strategies you mentioned earlier, Lonnie, about buying up properties and trying to renovate them and grow rents. But if you think about, okay, let's step back from this. Say if you're buying a property, you're going to add some amenities, you're going to add a gym. You don't usually see a pool added, but let's just, for example purposes, say you're adding a pool amenity and a lot of these really nice things. So sure, that's going to justify higher rents, but the expense side can also eat you up as well. So if you're not accounting for that in your replacement reserves or repairs, that's just kind of a false hope of what you actually think you're going to be dropping down to the bottom line.
I think that's what we're seeing in practice here, Stephen. Like revenue growth doesn't equal NOI growth. And, property tax reassessments upon sale is another thing that's really problematic for certain owners. And then just wrapping up here, if you don't know about upcoming new deliveries in your market when you're purchasing, that's a real problem, especially given the new supply that's been added in 23 and expected first part of 24. And then, what are the overarching long-term submarket dynamics? So like there are certain multifamily markets that have 1990s product, but they're in a really strong location, demographic-wise, economic-wise, where people have disposable income. And those assets still perform as Class A, even though they're at this point 30 years old. Then you have others where there's brand new properties in areas where the underlying fundamentals just don't support that Class A rent. And even though they're highly amenitized, they're not able to achieve the rents that they thought they would. So having just a general understanding of that is super important in these scenarios as well.
That's why you really care about median household income and not the average. Because when you have, say, a portion of very high income households, that skews that average higher, when really what you're dealing with is the typical median household income there.
Unlock a historic mall investment opportunity with Spinoso Real Estate Group's proprietary platform. Their expert team excels in identifying unique opportunities and conducts rigorous due diligence. With a proven track record of operating over 86 malls and 74 million square feet, their turnkey operating platform is poised for strategic execution. Partner with Spinoso and seize this institutional historic opportunity. To learn more, connect with the Spinoso team at the CREFC Miami conference this January. So if we continue to stick on this topic, I think we had 3 multifamily stories this week.
So the first one here, value of the NEMA San Francisco collateral was up. So we talked about this back in September. The value of the collateral behind a $384 million NEMA San Francisco loan was cut sharply and reduced to well below the loan balance. The loan, which is backed by a 754 unit apartment complex, was then sent to special servicing in August. So servicer commentary noted that there was a second appraisal ordered. The results from that appraisal have come in. So if we talk about the first reduction in value was 279 million. It's been upped to 328.8 million. And that was from an appraisal in October of 23. So again, that number is not anywhere near the loan balance of 384, but it's clearly a lot better than it was back in the $279 million range. The loan has not posted debt service above 1.0 since 2020.
Next up, we have Costa Mesa apartments selling for $234 million. The Southern California multifamily market ended the year with a bang as the Camden Martinique apartment property was acquired by Advanced Real Estate for $234 million, or $327,731 a unit, according to The Real Deal. The property is at 2855 Pine Creek Drive in Costa Mesa, California. The article notes that the sales price exceeded the sum of all Orange County sales over the first 8 months of 2023. When you talk about a bang, that's amazing when one deal can eclipse all sales for the year. So Advanced Real Estate will spend $45 million remodeling the property and has renamed it Grand Costa Mesa. The purchase was funded with $150 million fixed rate loan with a 5.95% coupon from Freddie Mac.
So that's an interesting acquisition, especially with the $45 million remodeling. It kind of talks about what we just did in the CRE 101, where they're buying something with a stated, value add reposition of the property. But in this case, they have a really nice fixed rate coupon with Freddie Mac, which makes this a lot less risky on the deal. One more multifamily story. Security Property sells apartments in Portland. So this was a sale near Portland for $99 million. Property was called Tessera at Arenco Station, 304 unit complex. It's in Hillsboro, Oregon, 325,000 and some change per unit. That was according to our own Commercial Real Estate Direct. Security Properties are a Seattle-based investment manager. They had purchased the property in 2018 for $85 million, and it was represented by CBRE in the latest deal. The property is located at 6523 Northeast Cherry Drive, had a $52.9 million Freddie Mac loan on it, amortized on a 30-year schedule. If you look at the trailing 12 months through September, property generated just over $5 million of NOI. Which is up significantly from 3.7 million in 2019 when the loan was originated.
And we had some trading alerts this week on the office segment.
First up, we have the Big Prudential Plaza loan got a 2-year loan extension. The owner of Prudential Plaza, now known as 12 Pru, has negotiated a 2-year extension of the loan with a chance to extend another 2 years beyond that. The news comes from The Real Deal. The 2.2 million square foot property backs a $385.5 million Prudential Plaza loan, which is split across several CMBS deals. The loan was set to mature in August 2025, so now the modification pushes that maturity to 2027 with the options that it could extend to 2029. And now, apologies in advance if I mispronounce this. Wangxiang America Real Estate Group acquired the property in 2018 for nearly $700 million. At securitization, the loan had a debt coverage ratio on net cash flow of 1.31 and an occupancy of 72%. For the first 9 months of 2023, the loan posted a debt coverage ratio of 1.15 when occupancy was 77%.
So let's move on here down to to New Orleans. There was an office that sold there. This was a property at 1615 Poydras, which is in New Orleans. Property backed a $30 million loan, and the sale has implications for the 2017 deal. Almost 500,000 square foot office. Recent special servicer notes indicated a sale was in the works, but for a price that was below the balance of the loan. If the property failed to actually close, there was going to be a deed in lieu that was going to be executed, but it does appear that the sale has gone through. The note had been delinquent multiple times in 2023. This loan is comprised about 3% of the 2017 deal. And you may recall, if you're a TreppWire reader, that in May of 22, we reported that FM Services, which was the second largest tenant, which at that time occupied about 26% of the space, terminated its lease effective April 23. That lease was originally slated to run until 2026. FM did pay a termination fee of about $2.3 million. This property has actually performed fairly well given the circumstance. For the 12 months ending March of 23, was sitting at a 1.54x DSCR at net cash flow, with occupancy sitting at 79%. And so, interesting story to talk about here in New Orleans. Wrapping up our office segment, we have an office story that comes from Hartford, where the occupancy has been reported significantly less than previous months. So this is one, again, if you've been listening to the podcast or reading the TreppWire back in February, we urged readers to footnote this almost $80 million loan at City Place 1. The Hartford Courant published an ominous piece back in February that said, the greater Hartford office market was really struggling, including this particular property. If you fast forward to now, a recent special servicer commentary indicates the property is only 47% occupied, which is significantly lower than the 86% occupancy it posted in June of 2023. This office is about 885,000 square feet at 185 Asylum Street. United Healthcare is the top tenant with over 375,000 square foot. Most of that space had a lease expiration of July of 23. The Hartford Courant noted in its article from February that United Healthcare was only occupying physically about 60,000 square foot of the 375,000 that it had under lease. And if you fast forward again to this month's special servicer commentary, the top two tenants have downsized. Bank of America is the second largest tenant, and the borrower has stated that it will no longer fund operating shortfalls. The loan was current as of December, but I think, as we mentioned back in February and fast forward to now, this is one to keep an eye on because it looks like the wheels have started to fall off.
And then in Las Vegas, we saw a hotel sale.
Yes, Apple Hospitality REIT acquired a 299-room Spring Hill Suites by Marriott Las Vegas Convention Center for $75 million, which works out to about $251,000 a room. The sales price amounts to just less than 10.7 times on trailing 12 EBITDA. Apple already announced 2 expected closings for 2024 and 2025. The REIT is expected to pay about $78.6 million for a 260-room Embassy Suites by Hilton currently under development in downtown Madison, Wisconsin. It will pay $96.7 million for a 256-room Motto by Hilton to be developed in downtown Nashville as well. So Apple Hospitality REIT making a lot of moves teed up for the future.
Yeah, they've definitely been active. It's good to see these transactions taking place. I think $250 a room for a Spring Hill Suites in Vegas is probably a pretty good comp. And it's great to see that there's still some development going on in Nashville, given some of the pullback in the headlines there from people, feeling like maybe that market's been priced out. So it's good to see some activity from the hospitality REIT as well.
And finally, for our property type segment, we have some retail stories.
The top tenant behind a 2017 retail loan renews. According to recent servicer watchlist notes, the top tenant behind the $27.7 million promenade at Tutwiler Farm loan has extended its lease. The collateral is a 223,000 square foot retail property in Trussville, Alabama. Academy Sports is the top tenant with 23.5% of the space. The lease was scheduled to end in February 2024, but watchlist notes indicate that the lease has now been extended to 2029. For the first 9 months of 2023, the loan posted a debt coverage ratio based on net cash flow of 1.59 when occupancy was 99%. And that loan makes up 6.29% of a 2017 deal.
Yeah, I think this is just more positive news for the retail sector. It seems like every week we're talking about occupancies, 96 to 99% range. And so it's great to see that this is another one with strong DSCR and strong occupancy. We had one more retail story this week. This is a quick hit. There was a tax appeal won for 2013 mall loan collateral. So this is according to December special servicer comments for the property at Solomon Pond Mall, an $84.3 million loan that backs that property, had the tax appeal go in favor of the property owner. The commentary did not list the numerical impact, showcases that this is good news for an asset that has struggled in recent years. So definitely, as we talked about in the CRE 101 segment earlier today, reassessment of property taxes can be a large line item expense for all assets, regardless of property type. And this property was once valued at $200 million, has been lowered to $30.4 million this year, which would suggest, even without the servicer commenting on what the reduction was, that there was probably a fairly significant reduction in the taxable value of this asset. This property had not paid off, even though its maturity date was in late 2022, and DSCR at net cash flow was 0.72x for the first half of 23. This is a pretty large deal, 46% of the collateral behind a 2013 issuance.
So just turning to programming notes here, we are about to be leaving for CREFC. So Stephen, Lonnie, and I, and a bunch of other members of the Trepp team will be heading down to Miami for the annual CRE Finance Council conference. We do have a lot of meetings booked with listeners already, but if you're going or you live in the Miami area and you'll be around, send us a note and we'll try to catch up with you. We're looking forward to connecting with our clients and friends in the industry. We'll be meeting with a lot of our past podcast guests and others who we may have on in the future. So make sure to send us a note. We'll be in room 440. You can come by and see us there.
Yeah, so I think we will have podcast t-shirts. Is that right, Haley?
Yes, we'll have regular podcast t-shirts that many people have received and then some special ones. So if you just want to meet us to get the t-shirt, that's another excuse to come by.
Yeah, so you should reach out if you want to meet up and get a t-shirt. We'll have a few there for you. As we wrap up this week's episode, Haley, I did want to toss out there, if you're somebody that listens to the podcast or works in the CRE or CMBS industry and you have any inkling that you might like to work at Trepp, or you like what we talk about, or you're interested in the data, shoot us an email at podcast@trepp.com. We think we're going to have some pretty exciting opportunities coming open, and we'd love to talk to some folks that have a general understanding of the marketplace, maybe worked on a research desk, could help us with our digging through the data segments, or, just love to meet people in the industry. So if that's something that excites you, please feel free just to send us a quick email or resume or whatever, podcast@trepp.com. We'd love to talk with you.
And one more programming note, Lonnie. Speaking of that, you could also work with us on exciting announcements and releases. So I'll let you take this one, Lonnie, because I know it's one of your product babies, but any of our followers may have seen today that we did launch an exciting new product and solution to the market.
Yeah, so we're super excited today. We released our new flagship CRE product called Trepp CRE. It's a dynamic new product. It gives our users access to about 5 million commercial property data records in our system all in one place. It allows users to do a lot of really cool analysis, actionable data. So it covers loan information, property financials, sales transactions, tax assessment data, lease information, all in one application. We're also introducing some new proprietary tools like our comps engine, pro forma financial models across the 5 million properties, and additional risk analytics at the property level. So people have come to trust Trepp as being, the leader in CRE finance data for more than 40 years. And now we're bringing you, data outside of the securitized universe, property financials and pro forma data on a much wider scale of properties. And we've incorporated multiple new data sets, developed new technology to link them together. And it's really the first of its kind comprehensive data set that encompasses millions of commercial property records with a lot of Trepp proprietary fields and insights. So if you're interested, we don't usually use the podcast to plug the products, but I think today it's worthwhile because this is a product we've been working on in-house for several months across multiple teams. And today is the release day, and we're really, really excited for the impact it's going to have on the market. Serves multiple personas in the industry. If you're a tenant rep or broker, whether it's acquisition, disposition, capital markets, valuation, this has a use case for you. And so reach out to us. We'd love to schedule a demo. We'd love to walk you through the new platform, and really excited to see, as we mentioned, the impact this is going to have on the industry.
And turning to shout outs, so a lot of these were people who actually came in to us because they were requesting access to our new daily newsletter. So reminder to email us if you're not on that list yet. But Alyssa A said she's an office investment sales broker in Chicago, and we're actually going to be meeting up with her in Miami. So we'll see you soon, Alyssa. Stephen B has been listening to the show for a while and says to keep up the great work. Brandon K loves the podcast. Steve M says he loves the show and wants the newsletter. Oscar G is a loyal podcast listener who's interested in the daily report, and he's looking forward to connecting in Miami. So we'll see you there, Oscar. Adam F is a huge fan and appreciates our thorough analysis of the market. Mike Yu has been listening to the podcast for a while and loves it. Josh G thanked us for our content. And then we had a few others from Carl M, Nick T, Jacob M, Roger F, Ken M, Harry K, Zach A, and Michael W. So, Stephen, I don't know about you, but we mentioned C. I think I might need to move my flight because we're expecting a snowstorm. And I think the headlines were the first snow in 700 days. So we'll see what we actually get here in New York. But we haven't had snow in a while. And of course, now we're going to get it on the day we're all trying to escape to Florida.
I know. I moved from Texas to New York, and everybody was like, oh, you're going to move into a colder climate and lots of snow. Lo and behold, no snow.
You haven't had it yet. So we'll see if we make it to Florida. We might have to all travel on Saturday or we'll get there Monday, but should be good. And we'll hope everyone stays safe in the storm. And with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well.
All right.